Welcome to Money on Tap, your personal finance headquarters. Money on Tap's where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this radio show or podcast, however you're getting us today. We look at all sides of the issues, and we're bringing a fully independent planning perspective to the table. My name's Seth Krussman, and I'm joined here once again with John Ryder and Ben Brayshaw. Good morning, you guys.
Good morning, gentlemen.
Good morning.
I should say good morning back again. I feel like I need drop the ball there.
Say
with
it,
you guys.
Seth. Say it again. It is.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. You can also find us at Facebook /3D Investing or Twitter, folks. You can find me at Twitter at BFG. That stands for Brayshaw Financial Group. BFG_LLC at Twitter. Either way, we look forward to connecting with you. And I think our topic this morning,
our topic?
I think our topic. That's John. That's
I
what
know
you
our topic.
in my note here.
I know what we're talking about today, Seth. I don't know what you're talking about, but I know what we're talking about.
It's going to be fun. As a matter of fact, we're going to be talking about something most people have identified or had an experience with here. And these are recent things, too. This is not something that we're, dredging out of your father or mother's 401k plan, which they may or may not have had. But we're going to be talking about.
Keep my mother's 401k plan out of it, Seth.
Okay. I've tried to, John.
You guys are always trying to make the show personal. I don't understand.
We're going to be talking about target date funds. And you know what? Over the last several years, there's been a huge trend in that the 401k industry. And it's been a lot of momentum that has been built around the target date funds. Today, we're gonna get down into the weeds a little bit, talk about these fund options, what they are. Maybe you should use them, maybe you shouldn't. And you know what? If there's a reason to avoid them, I think we're going to bring that to the surface today.
I think this topic couldn't be more timely. I think there's been so much conversation, expectation. The road has been paved to target date funds, and I think if someone's listening today, this is probably a crucial piece to their 401k future and their retirement future to hear this program. This is going to be important.
Yeah, in fact, a lot of our listeners that we've had actually come into the office, we're finding, I don't know, Ben, it seems like most of the folks that we've been talking to are fully utilizing these when we initially talk to them. And you know what? We are going to talk about pros of target date funds because there definitely are some, but there's also some cons that we want to talk about as well.
Yeah, and I think depending on your age, it could be bigger pros, and depending on your age, it could be smaller larger cons and so forth.
For sure.
This is one of those areas where I don't think people have enough understanding of what they're doing, what they're buying, and for some, they're doing tremendously well, and they don't even know why.
Yeah. So my challenge is this: if you have a 401k out there and you are just looking for advice, guidance, this is what we do, and pay it special attention to this show because this is really going to give you some ideas to consider for your 401k.
Hey, before we get too far down the road, it is time for Money in the News.
So, an interesting article that I'm seeing here today is Trump signs executive order on retirement savings, which is pretty interesting. Lots of presidents sign executive orders. I think Obama signed a lot of executive orders. It looks like Trump is doing the same. But this is one that's pretty interesting. The directive aims to allow retirement money to be spread out over a longer period to make 401 401k plans more accessible to small businesses. So this is just this past Friday. He signed an executive order directing the government to review the rules that are requiring retirees to actually start taking annual withdrawals. We call them in the business, we call them
those RMDs.
Yeah.
Yeah. So the required minimum distributions. We've done shows on RMDs before, but ultimately forces people when they hit a certain age, which is 70 and a half currently, to take the money out, of their retirement plan, essentially forcing them to be taxed on that money. The government says, hey, listen, you can accumulate this wealth. We'll let you tax defer it, and we'll also, let you delay taking it out. But there's a point in time where we're going to need our tax dollars from you, and 70 and a half for everyone is the age they call for that. So it's interesting that they're actually addressing this, because this hasn't changed in, I don't know when. I don't know if it has ever been changed, but they're looking at trying to either extend it by extending it, they would be reducing how much you have to take out, which would.
This is not typical government executive order here. This is kind of the opposite, because typically you might see if the government wants their money, they might say, well, hey, you need to take it out sooner than 70 and a half. But now it sounds like they're talking about some ideas to actually delay. Because quite honestly, guys, we have a lot of folks out there who have 401ks, have IRAs. They don't want to pull their money out. They're doing fine. They don't need their RMDs, but they have to.
So the reason why? It's going to accumulate without getting taxed, right? That tax drag that can happen on investments outside of the qualified investments is what we call them, basically, where the accumulation can happen without being taxed. But once the distribution happens, which that RMD, required minimum distribution, takes place, that's going to be ordinary income on the way out. Ben, I think you already mentioned that. I just like to just stand on, some of the points that you make and stand proud and tall on the points that you make there, Ben and John. So that's what I got to offer.
I'm glad you threw and John in there too. I appreciate that there, Seth. Thank you. Thank you.
That seemed gratuitous. So
at least it's not self-gratuitous. That's good.
So, I think from the conspiracy side of this, right? I mean, we are running down a debt hole so deep, so big, so overwhelming. Our country doesn't understand what we have in front of us. And I think delaying, they say, well, why would the government allow us to delay the IRA, to take the income out and the taxes and all that stuff? Seems really like this is a huge benefit for us. There is a lot of tax benefit to delaying, those taxable funds. But if you're not an optimist on tax rates, I mean, yes, Trump reduced them, but when we hit the, cross of turbulent times, and these bills and these debts have to be paid, or Social Security can't actually fund itself anymore, or Medicare is again out of money, and all these I mean, when money needs to happen, tax rates will rise, and they will rise significantly. They have to. And so the government delaying the tax bill on these things forces people potentially into a time period when they do take it out, they may be at a higher tax rate than when they put it in.
Exactly. Mm-hmm. Seth, you've been doing a lot of work when it comes to 401ks and all that. I know that you've been doing a lot of 401k work these days. But the second part of this article I think is pretty interesting. It says this: the executive order also would direct the Treasury and Labor Departments to consider issuing regulations that could make it easier and cheaper for smaller employers to band together to offer 401k type plans for their workers. I don't know if you want to speak to that or not, but I mean,
sure. Yeah, there's lots of companies out there in the 401k space that are providing these plans, and they want the 401k business. That's how they make money, basically. And there's some of these companies that are going to work with groups of a certain size and scope, and that's going to be kind of their niche. And there are companies that are really focused on helping new plans start. And so there are fee options out there that are lower on the fee spectrum, but the other part of that I think is interesting is that this is this can be a deduction. The fees can be a deduction to the employer. So it's kind of a moot point, I think, to get one of these plans up and off the ground. Typically, the employer is profitable and has employees and is looking for ways to improve the life and the wealth of their employees and their culture. So at that point, it's kind of a moot point because the fees are in that spectrum that they're not going to keep an employer from rolling out something like this. So the other side of that is too, is there are other plans like the simple plan, which can be
simple IRA.
Yeah, simple IRA, which is, very low cost for employers to roll out. And, there's the difference between, what a 401k has to option versus a simple is not that significant unless you have a very profitable business. And then that's where, you want to start to look more into the 401k and some of the flexibility around contributing into that 401k plan. They can be much larger contributions in the end game towards those 401k plans. So that's where I kind of take a look at this information. I'm like, well, there's a sales ability to it, I think, that they're trying to roll with here, but I don't know that necessarily makes that big of a difference. I think the bigger difference here is kind of elongating that time frame of possibly those RMDs and taking a look at the life expectancy of the population as a whole and saying maybe we don't need to have such a high rate of RMDs pulled out of these IRAs. Maybe we can kind of postpone some of that.
Well, I think there's a couple of things going on in that conversation that are interesting to me. And with simple IRAs, you can only have a company can only participate in a simple IRA if you have 100 or less people in the company. So you're capped out on the number of people. So also the contributions for the simple IRA are less by about 2/3 roughly of what you can put into a 401k. So you have some limitations there. You have some obligatory contributions the employer has to make in the simple, and that can get a little funky with a 5-year testing rule and whatnot. But I think with a 401k, it's just really cost prohibitive for a small company. And that's what Trump's saying here.
That's what he says. He actually says this. He told an auditorium of supporters in Charlotte, such a big thing. They'll be banding together. Small businesses will be able to pool their resources so they can have the same purchasing power, even more, frankly, as large businesses. So he's looking out for the small business guy, I think, here.
Right. We've opened up 401k for small businesses for 2-3 people, but it's because they're maxing out contributions and they need the volume to get the money in. Those are real things, and there are some ways to kind of adjust that for fees and try to make it more affordable. But what really happens, and the reason a lot of people don't do this, is the time and effort falls on the advisor. So with a 401k, like a true 401k plan, you get the breadth of the marketplace a little bit. You can you could have lots of different mutual fund companies. You could have just one mutual fund company. You could have stocks. You could have attach defined benefit or pension plans to it. There's lots of opportunities to start, adding like limbs to that plan as as a imagery kind of concept here. But it's just so expensive. I mean, to get a TPA involved, and so most financial advisors don't want to do the work that it takes, and it still is limited. I mean, it's maybe better than a simple because of how much you can put in, and maybe a little bit more breadth to the different investments. But it's still limited. So you get what you pay for in this industry, and most advisors can be like, yeah, well, it's best to do this, and you spend the money because you're not going to pay me to do it. That's a little bit of the background of some of that stuff, I think, too, right, Seth?
Maybe.
Thanks a lot.
I'm not going to stand on that and raise my arms high above my head like I was before. I'm going to raise them down a little bit lower to my shoulders and say, yeah, okay.
Good. All right.
Next on our bill of goods here at Money on Tap, we've got some Warren Buffett in the news. Number one lifelong habit of Warren Buffett. Any guesses?
Save money.
Good guess.
Don't spend money. The guy still lives in his own same house that he built 37 years ago for $125,000. Isn't it amazing, that guy? I mean, think about that. He lives like 5 minutes from his...
He drinks a Diet Coke for lunch every day.
Yeah, goes to McDonald's. I don't know.
Yeah. His breakfast
not caviar dreams there, man. Yeah.
He knows based off of what breakfast he's going to have at McDonald's. There's a difference of, I think, a nickel.
It's amazing. One of the wealthiest guys in the world. It's just amazing.
That's why he is
very, very.
But I have clients who are super wealthy, and they don't spend money.
Yeah,
that's how they've. And it's not that they make, huge dollars. They make a great living.
It's a classic millionaire next door. I mean, but this guy is the classic billionaire next door, and I don't know how many of us have billionaires next door, but this guy, something else.
I guess we wouldn't know.
Yeah.
Well, here's one of the ways you might be able to tell. And this is his number one habit, lifelong habit, is that Warren Buffett spends 80% of his time reading and thinking, and has done so for his entire career. And that was one of the things that was amazing to the person that was writing the article here. Let me get a notation, a nice big picture. Michael Simmons.
Does it say waking hours, or is it all 24 hours? Because, I mean, he's got to be sleeping at some point. So is the disparity of percentage based on sleep or no sleep?
Well, I don't know about that, but there's some highlights in the article to his schedule, or some references to his schedule, and noting that haircut gets in there on a weekly Tuesday.
Yes, every Tuesday, yeah.
Every Tuesday. And now this is the thing that I thought was a really great takeaway here, is that there's a case here for the learner's lifestyle, is what they call it. And, to be first in the knowledge economy, and learning and thinking are the single best long-term investments that you can make with your career. And learning and thinking can determine our decisions, and the decisions determine our results. What do you think about that?
Who am I to argue with Warren Buffett?
I wish all of us could sit back and spend our time thinking and learning. But I think, when you look at our educational system, we try to shove all the learning up front, and then we try to create all the output on the back end. There's a lot less, continuing education pieces. I mean, they've forced them into our industry and legal industries,
medical,
accounting industries, but
teaching.
But there's, they have to force that in there, where he's doing it as a real intentional.
Yeah, no one's forcing him.
Step, and it's nowhere near 80%, right? I mean, we struggle trying to get some of the CE stuff that we have to get done on time sometimes. So it's difficult.
Agree. Yeah, it is difficult to find the time to invest in, ourselves and our own education. And I think what you were describing there was the culture around lifelong learning. And I think you hit the nail on the head. We've got a culture that really says, you know what, you're going to be doing this. Your education is 12 years or 16 years, and then you do what you do. And it's all about just doing that. And it's not necessarily about taking the lessons that you've learned through that and building on them and adding to that. It's about going out and taking the skill set that you've got and then translating that into an income somehow. So I think it's brilliant to have somebody out there like Buffett saying, "Hey, this is a lifelong a part of who I am."
Yeah, he says in this, Seth, he goes, Buffett's genius is that he prioritizes learning so he can have higher quality insights.
It makes sense.
No, it does. And then Drucker goes into this piece here. It says, define what quality is and then create processes that maximize it. And I think that's really the piece of business that every business owner is trying to accomplish. It's just the quality of the output, no matter what industry you're in.
Well said. Well, that's going to do it for Money in the News. We're going to take a quick break and be right back. You can reach us at 855-226-8551. You're listening to Money on Tap.
Hello, my name is John Ryder, a partner with Brayshaw Financial Group and one of the co-hosts of Money on Tap. 10,000 Americans are turning 65 every day, and planning a successful retirement today is more challenging than ever, with a roller coaster stock market, political and economic uncertainty, and so many unknowns when it comes to the escalating costs of healthcare. Let us show you how we utilize the 3D method of investing, utilizing insurance, brokerage, and fee-based planning. Using our experience, let us help you plan for a successful retirement. Now is the right time to start getting help. Give us a call at Brayshaw Financial Group at 855-226-8551. Headquartered in Bedford, New Hampshire, we have offices across the country. We would love the opportunity to meet with you. There's absolutely no cost or obligation to meet with us, and we welcome you to our offices. Call 855-226-8551 today.
More Money on Tap in just a moment. On this Cliff Notes edition of Money on Tap, Seth, Ben, and John have a discussion about wills and the alarming percentage of boomers who have neglected to have a will in place.
Statistically, 44% of boomers still don't have a will. 44%.
Yeah, it's huge.
Yeah, but 57% people don't think they're going to have any money to pass on. So they're saying, well, why waste the money on a will because I'm going to spend it all anyways.
Well, that's true because then you're right. The 35% plan to spend whatever money they have left on themselves. But, I mean, there's always the what if scenario. Like, what if I don't make it to that day where I've just completely cashed out?
We have people, they walk through the door. I sit down with people and they're like, you know what? If I die and there's money there and someone's got to figure it out, well, let it be their problem. I don't want to worry about,
Make them work for it.
Yeah. And it's like, well, it could be more efficient and you save a lot of money that you've worked really hard for to pass on to your family or friends or charities or whatever. And they're like, I don't care. I'm not going to care because I'm not going to be here.
Sometimes it's interesting to get all these different perspectives that we get a chance to get a bird's eye view of. And we have different perspectives ourselves. I know that when we're talking about our own families and our own family's plan, John is different from Ben, is different from me in how we're planning what our intentions are. And so all across the board, no judgment, people, just interesting to find out what the numbers are.
I think one thing that's not monetary around doing proper estate planning and doing these documents is preserving the family unit. Because if you leave this thing just...
Not buttoned up.
Yeah, not buttoned up. You're going to create a huge amount of strife and stress inside the family unit. Even if you don't have an I love you will, as they call it, to your spouse, it can be frustrating. It's complicated. And if you don't make this thing neat and clean, it's just going to create unnecessary problems inside your family. Who cares how much money they do or don't get? If you don't want them to...
They all hate each other after you're gone.
Yeah, what did you really accomplish? I think that's the non-monetary thing to focus on in this area.
Thanks for joining us for this Cliff Notes edition of Money on Tap, with great tips from the pros in three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. Now here's more Money on Tap with Seth, Ben, and John.
Welcome back. You're listening to Money on Tap, your personal finance headquarters, where we bring out the professional's experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. So you can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. Today, we're going to get into our main topic here, spending some time talking about the pros and the cons of target date funds. Just about everyone out there we know is working, everyone that we know that works is in a 401k. I think that's what I meant to say, or has something like that available to them. And inside of those plans, there's more often than not, there's an option to select what's called a target date fund. We also call them glide path funds. First of all,
I don't call them that, Seth, but you call them that.
I call them that behind your back, John. You just don't know it.
Well, hey, let me just talk a little bit about what target date funds are, or as Seth would call them, glide path funds. One of the most successful innovations in personal investing out there is the target date fund. In just over 2 decades, these have amassed almost $750 billion and become the default set it and forget it option in many 401k plans. Because many of their managers continually rebalance and update the portfolio allocations over time. Target date funds addressed a persistent challenge for investors, shifting their portfolios from riskier but rewarding equities to stable but safer bonds as they age and approach retirement.
What does this look like when you're in your 401k or sitting down and getting enrolled in your 401k, get that rollout that might happen for you? You're going to see there's usually going to be about 10 to 15 of these options on average, and they're going to say 2040, 2030, 20, maybe even 2020 if you're that close to retirement. That might be the kind of your target date that you're looking to retire by. The year that you're looking to retire by. And that's what that means by target date.
So if I'm a young kid, and I'm 21 years old.
But even that is not accurate. I mean, you're right that it's a date that you're saying I'm shooting for something, but it's whether you're shooting to get there or go through that date. Like the way these companies are investing is not the same. So they're not saying that the funds will be ready for you like if your retirement date is 2020 and you choose that. Some people are saying we're carrying that out and we're continuing to blend and de-risk, your portfolio as you get older, but that your retirement date is 60, we assume you're going to be 65 or whatever age they're making the assumption, and that we're going to invest through that because you're going to live to 100. And then some companies are actually saying that that's the day we're going to give you your dollars, and we're going to have taken the risk. Like, that's the end. We expect you to move on.
Okay, so bring it back to big picture, though. Let's say that we have a 401k plan. You're part of a large company, and you sit down. You're 21, 22 years old. Basically, what you have is you have a cafeteria plan, right? So you're walking in there. They're saying, hey, you're now eligible to save. You really haven't saved any retirement dollars before. So you have a bunch of different choices, and you might have choices from Fidelity, from Vanguard, from Franklin Templeton, and from Dreyfus, whoever it may be. You can pick those and pick individual funds. It could be stock funds, could be equity funds, could be bond funds, whatever you want. You have full option. There's no one telling you have to do this certain fund. But then there's also another selection of funds out there, and those are what we call the target date funds. Basically, just have years assigned to them. The year that you would perhaps retire. Maybe you'd be, but it's going to be for someone that enters the plan that's 21 years old, that's 25, 30, 35, and so on. So no matter what age you're in, you can come in. It could be that you're 60 years old, you just got into this company, and that you need to pick up a plan that's going to be 5 years from now. So in 2018, be a 2023 fund. So basically, you have a cafeteria of options. But the whole idea with target date funds is to allow the investor to sit back a little and just to let the fund do its thing. So as the investor gets older, the equity holdings typically automatically decrease, so the risk on the underlying portfolio goes down. And that can be a really good thing. But let's explain a little bit how that works. Seth, do you want to kind of talk about that, the mixture between equities and bonds, that type of thing?
If you're talking about glide path,
let's talk about that glide path. Let's talk about it.
So there's the strategy that these funds are trying to shoot for, let's say. And this is general, right? We're just speaking very generally. They're going to, if you have quite a ways until you're going to retire, right? So let's say that's a 2050 target date.
Yeah.
What they're going to do is they're going to push a lot more of equities and stocks.
Yeah, more risky.
Risk. Yeah. That's a more risk on strategy. And then they're going to put in the blend, they're going to maybe do 80% stock, 20% bond. And what that is doing is it's saying we are risk on, we are higher risk, and we're able to accept more volatility, right? There might be, the stock market might be going up, and it should kind of keep pace with what a stock market's doing going up, but it's at the same time it's going to do the same thing pulling back. So if we, have a pullback in the market, that fund is going to do the same thing. Now, as you get closer to that retirement date, what that fund is supposed to do is start gliding along in that path.
There you go.
From stocks towards bonds. So more bonds. And what that is supposed to do, what the underlying purpose of that is to smooth out that ride, and hopefully you should see potentially less returns out of that. Yeah. So you won't be keeping as much pace possibly with the market and what the market's pushing out as returns, but you'll be de-risking that portfolio. Now, that is what it's supposed to do. Is that what happens all of the time?
I don't know, Ben, but to me, that sounds kind of attractive. So if I'm 21 years old, I get into an account that's maybe a 90-10 mix, maybe it's a 2060 retirement fund. It's kind of attractive to me that I just put my money in, and then all I have to do is just keep on putting money into that thing. And as I get older over the years, and as I stay with that company, and over the years, it just gets more and more and more conservative. Why wouldn't I want to do that?
So, it's interesting. Have either of you guys had anyone come into the office and say, hey, I really want to buy a target date fund from you?
No, never from me. They've talked about how they've bought that in their 401k plan,
right.
Yeah.
But they're not looking for that. Why aren't they looking for that? That's a good question, right? So, the thing that's really interesting I find about target date funds is they are just a mess of potential litigation for, basically the companies who are providing them.
Why do you say that?
They have been. So there's a few different things. One is that, there's a couple different there's articles everywhere out there, right? But the first piece is it advice? Is what's going on out there really advice? Like they're actually trading these assets based on, their belief in what's going to happen and how you should be investing. So is that advice?
It's kind of a strategy. It sounds like a strategy to me, kind of more of a...
Well, the whole thing is, and then you ultimately don't even know what the underlying holdings are until you own them, right? You have to actually go through the piece of the fund being provided and find out what is actually in that fund. I think that could be dangerous if you have certain standards of what you would or wouldn't own, right? I mean, think about that. I mean, you're just saying, throw me in this bucket, I'll own that, which we do on some level with almost any fund that we buy, right? But you have a better understanding of the focus. See, the focus of this fund is to get you either retired by that date or through that date, expecting that you're going to carry on till 80 or 100 with that fund.
I don't know, but what I love is what I like about it is it's just so easy. So you don't have to spend much time. You don't have to spend much attention. That's a real pro to me. But the con would be, I guess I don't really know what's going on with it.
Well, what is the right debt and equity ratio here? There's no standard to these things. So everyone has, my whole point is that as these things are flowing through, you're looking at this saying, should I be a 70-30 at this age or a 20-80? And no one's actually sat down with that person and said, this is the kind of risk I want to take.
That's exactly right. And you know what? They're not looking at ancillary assets either. It's very easy to say, so I'm 45 years old. Well, I don't have necessarily 100% of my money sitting in my 401k plan. I might have a lot of outside assets as well. It could have been money I earned or money I inherited or whatever, but no one's taking into account the risk level there. So just kind of slapping a label on a fund and going into that doesn't necessarily make a lot of sense for most people. But we do see, just even the numbers show, that the great majority of people out there are just saying, I don't want to meet with anyone. I just want to put my money into that 2050 fund because that's when I'm retiring. It sounds really easy.
Well, so there was all these lawsuits post-2008 and the crash and all this stuff. And a lot of it had to do with the fact that these companies had violated their own prospectuses based on how much debt and equity they would have.
I think you're touching on a really interesting part of this conversation, Ben.
Good. So
whatever you say, I'm going to jump up and down with my hands raised high.
All right, good.
To circle back. Yeah.
So, I think that's the part that's really crazy is the amount. In other words, they're pretending to understand your risk by deleveraging your risk potentially to debt instruments of some sort. Okay. And, every prospectus is a little different. So, you keep deleveraging that piece. They've never done a risk assessment for you. You're just choosing a date, and then they're moving according to that based on whatever standards they believe to be the case, and they all have a different set of standards. So, the question I have is, when are standards going to be set? That if you're going to make these assumptions, because I mean, the amount of work that's going into this, and then they're not even following their own prospectus, and they're trying to create returns and protect people's assets, but they're not following the prospectus in order to do that. It's crazy.
So the prospectus should be the standards, right? That's what we're talking. You were just talking about what are the standards? And
right.
For one, the prospectus should be the standards. So if they're not sticking with the standards that by prospectus they should be, they're out of alignment. Now,
so
the reason for
90% of the people that we're talking to today probably don't even know what the word prospectus means, or that they're entitled to one. So a prospectus,
right,
okay, is that documentation that tells all about what you own, and you have the right to get one. And they mail these things to you in the mail from time to time. Most people turn that off now and say, just email me all my literature.
And then hit delete.
Yeah, and then they hit delete. And it's the big books. Now, what's interesting about the target date fund prospectuses is they will have inside them these kind of blending strategies of what their
how far that can go as far as equities and bonds. And
not to confuse words, but their perspective of the market is going to be, and how they're going to reduce their equity exposure, increase their bond or fixed income or whatever that's going to be, as time goes on. But you need to understand, like, looking at those, you're going to see completely different perspectives of how they're going to blend those all together and do that movement.
So there's a part of the economy that happens here that people are looking at how well have these funds done. And, the better that a fund does, typically, the more the inflows of money are going to receive, right? The more that they get paid. And so if they are lagging in performance, What are they going to do? How do they bring back, an increase in the performance? And typically that can be taking a look at that leveraging of the ratio of the equities to bonds and looking, at the equity side and say, we're going to go more back into this equity side. Or they could take a look at other markets outside of the typical U.S. stock market, world markets, and say, we're going to go into higher risk levels in order to try to achieve some of these returns and capture some more of those inflows. So it's a catch-22 here for them as well. I mean, they want to perform to be able to get the money in the door, but to do that, they have to take on more risk.
So there's a couple things that I'm really concerned about here. And it's different age brackets. So Seth, you're talking about, you're looking at all these performances for
30 years out.
Yeah, 2025, 2030, 2040. And theoretically, right, they're taking this kind of generic historical data. And we've talked about this before. We've taken this generic historical data for the last 30 years and applying it to the next 30 years, okay, and saying if we invest this way, we're going to be winners. This is the way you should do it because this is a standard. The problem is we have that demographic we talk about all the time, which is the baby boomers and all the retirees. That's in the next 20 years. That's 120 million Americans controlling, the majority of all the assets in this world for our economy, and how they invest now is not the way they were investing for the last 30 years. See, people don't understand that we're basing all of our future investment strategies on basically an eclipse, the eclipse of the investment world, right? I mean, we had this baby boomer, this huge accumulation baby boomer group, and they're going into a distribution phase. And that eclipse is going to change the standards of the next 30 years of how you make money. So investing in strategies that are 30 years old that don't have the same standards and the same outcomes is a little naive, considering the fact that the baby boomer populations, and the rest of the people who retired, are about 40% of today's current, people alive in the U.S. People don't understand the complete difference between yesterday's market and tomorrow's market, and they're investing today as if it was yesterday, and not understanding that they have to perceive what the future is going to hold. We got bigger problems. And take the demographic we're talking about out of that. What about rising interest rates?
Well, that's an issue right now for folks that are in these time target dated funds. Let's say that you're 60 years old. And let's say that you have a target date fund at your disposal there and you're using that. And your target date is 2023. Now, the typical prospectus-driven
I appreciate
target date fund.
That quick math you just did,
yeah,
John.
Well, that's fast for me, Ben. You know that. So you figure if you're in a 2023 fund, what are the equity managers, what are the managers of that fund doing? They're loading you up in bonds.
Yeah.
Loading you up in bonds. And now as we take a look at kind of where we are in our interest rate economy, and we certainly know, not that we have any guarantees of what's going to happen, but we all, if we have 100 people sitting down in a room talking about what's going to happen with interest rates, and we ask people what we think they're going to go up, down, or stay the same, you're going to have just about 100% of that room raise their hands thinking they're going to go up, because interest rates have been at an all-time low for a long time. We're starting to see some signs of increase. But we all know that if we have, or many of us know, that if we have 100% exposure or 90% exposure to bonds in our portfolio, there's an inverse relationship between interest rates and returns. And so if we have a bond and that interest rate goes up, the value of that bond goes down. Well, what do you think is happening to the value of that 401k plan? That
right. So if you're going, I mean, to be obnoxious about the percentages, but let's say you're going from 20, then you're going up to 30% bonds, and then 40%, 50%. You're going, all this debt exposure is going up. And then all of a sudden rates keep rising. I mean, I've heard that potentially 2 more rises between now and the end of the year, maybe 4 next year.
Yeah.
I mean, that's a lot of rate increases, and that's a lot of,
That's a lot of bond exposure.
So what does that force these target date fund managers to do again? Say, you know what? We got to be at the bottom end of this bond exposure, and they've already broken the rules before. I mean, they're trying to protect the asset. They don't want people to lose money. They're not here saying, hey, this is a great idea, let's lose money. No, they're being paid to do this job, and you're hiring them to do this job by buying that fund. The question is that how you should be buying the fund? I think this is one of those pieces where we don't even know, without digging through every prospectus, you don't know what the underlying, securities are that are creating, whether it's just, it could be just treasuries. It could be, they could be buying anything under the sun that's a debt instrument based on whatever their prospectus says. And you may be going negative theoretically against inflation and so forth.
Hey, we're going to take a quick break. We're going to come back with more on target date funds. And believe it or not, I think we have some perspective around these that we do like. And I think we'll share some of that as well. But until then, you can reach us at 855-226-8551 or email us at info@yourmoneyontap.com.
Hi, my name is Ben Brayshaw, one of the co-hosts of Money on Tap. If you have questions when it comes to your retirement and are looking for a personalized solution, contact us at Brayshaw Financial Group. In today's volatile stock market, we can help you plan to find your successful retirement solution. Am I saving enough? Am I saving into the right places? Do my investments match my appetite for risk? Do I have a tax strategy that is going to help me keep more of what I earn? How can I maximize my Social Security income? If you are like most people, you are getting closer and closer to your retirement and may be wondering if you're taking the right steps. If you're in retirement, you may be wondering, am I maximizing my income while preserving my estate and caring for my family? We talk about all things financial in what we call three-dimensional investing, putting a plan around your financial future. If you feel that now is the time to start getting the answers to some of these questions for your own situation, give us a call at Brayshaw Financial Group at 855-226-8551. Headquartered in Bedford, New Hampshire, we have offices throughout New England and across the country. We would love the opportunity to show you how we can help. There's absolutely no cost or obligation just to meet with us, and we welcome you to our office. Call us at 855-226-8551.
More Money on Tap in just a moment. On this Cliff Notes edition of Money on Tap, John Ryder introduces an interesting story about a lawsuit that wraps up with an incredible outcome.
Ex-Chipotle manager accused of stealing $626 given an $8 million settlement for wrongful termination. New York Daily News reports that this manager, her name was Jeanette Ortiz, she was accused of stealing $626 in cash out of a cash register from the safe of a Fresno, California Chipotle Mexican grill. She was very quickly fired for this blatant thievery and justice was served. Right? Well, not quite. While her superiors maintained that the act was caught on tape, they failed to provide this purported surveillance footage and claimed it was destroyed. Frankly, claiming your main piece of evidence was eradicated isn't exactly the best legal argument in a courtroom. They accused her of something, they couldn't prove it, and now she is going to be retired for the rest of her life with no worries in the world at all.
Honestly, this is what's like bizarre about our legal system or wrong about our legal system. It's like, did she really steal it? And then she got $8 million. It's like, this is what the problem is with our system. We're encouraging more people to create more lawsuits. It's like the cup of coffee. Everyone knows the cup of coffee that's built on the person at McDonald's and they won millions. It's supposed to try to make you whole. No one ever is whole from anything, you know? And so to overcompensate or only exacerbates the problem we have in our legal system.
Thanks for joining us for this Cliff Notes edition of Money on Tap, with great tips from the pros in three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. Now here's more Money on Tap with Seth, Ben, and John.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com.
So, you know, there's a lot of, you know, we've talked about a few pros. We've talked about a lot of concerns would be perceived as cons, but how you invest in what you want to accomplish out of your own portfolio is really important for you to be specific about that and intentional about that. I think there's one thing that, you know, Seth, that's really a positive or potentially positive for the target date is kind of the younger you are, the better off you are, because there's a lot more set it, forget it ability to take on more risk and less management on your side. As you obviously get closer to retirement, whatever age and time period that is, the amount of time you spend looking at your portfolio and what you own in there needs to increase, right? So if you're 25 years old, maybe it is a set it, forget it, because you're just making small contributions trying to get this thing off the ground. But by the time you're 60 years old, if you're not in your portfolio and you don't understand it, you're not sitting down with a financial advisor, even if they're not managing your 401k, that's something you need to do. And I think there's some real opportunity with some of these target date funds that are, you know, 30, 40 years off to actually make some money. Now, even with the demographic swing, I think there's some real opportunity over the next 20 years as people are deleveraging risk and kind of getting out of the small cap world, maybe, and some of the higher risk investments. I think there's going to be buying opportunities, and some of those portfolios are going to take advantage of that if you're really young. So if you're a millennial, there may be some real opportunity inside of that. One thing I find concerning in the target date funds in conversations I've had with people, and it's not about the fund themselves, but it's about their own personal management style, is they're looking at these target date funds, right? And they're looking at 2020 and 2030, and they're going out in time, and they're seeing returns increase potentially as they go out in time because the risk is higher into equities, right? So to compare your target date funds based on their returns would not be an apples to apples comparison.
Yeah, there's a different
Unless
level
you're
of risk
keeping it within the same band of the year.
Exactly.
Right. Yeah.
Right. So a lot of different companies provide target date funds. I mean, you've got Vanguard, Fidelity,
all the big boys,
Schwab. Yeah, you got all the big boys.
And some of them shouldn't, frankly.
Yeah, some of them shouldn't be doing it at all.
Well.
But it's such a popular conversation, and it takes a lot of the you feel like the onus is taken off you. That's why the lawsuits have started, because people say, well, I thought or I understood
I was conservative.
this was going to manage this money for me and do all the, and they got burned. So, but anyways, it's interesting. I just think there's a lot of opportunity inside target date funds, but I think it could be really just certain segments of age brackets that might benefit really from this.
Ben, that's an interesting segue. I want to bring up for our concluding article here a special report from Reuters. The title of it is this: Fidelity put 6 million savers on a risky path to retirement. It says this: for 3 years, the mutual funds in Fidelity's flagship retirement franchise have outperformed at least 85% of their competitors, reversing a decade-long trend of subpar performance. And yet, client money has continued to flow out of the firm's freedom funds, that's their target date funds, as retirement plan sponsors to shift worker savings to rivals in the target date business. So basically what's happening here, and the article kind of exposes, is that many of these target date fund managers have turned to riskier investments to boost returns, and Fidelity has gone further than its peers. And it says that these funds with high concentrations in stocks are a time bomb. This is an analyst for Target Date Solutions, the name of the company. It's a research firm. The sector is even riskier today than during the 2008 financial crisis, when some funds dropped more than 40%, he said. Fidelity spokesman Vincent Loperaccio said today's American savers can handle more risk because they retire later and live longer, allowing more time to recover losses. He says the Freedom Funds are a lifetime savings solutions, that they deliver exceptional performance for shareholders taking appropriate risks. But the problem is, a recent global market sell-off underscored how Fidelity's growing appetite for risk could amplify investor losses. So some of these funds out there, these target date funds,
this is such garbage. I appreciate what he's saying, but people are not just retiring later because they want to.
There's certain reasons that trigger that, perhaps, right?
Yeah, I mean, they're retiring later because they need more funds to survive most of the time. So to make the assumption that because people are retiring later, these things are even better, it doesn't even. That's just garbage. Appreciate it, but that's just really putting people into a box saying, well, now I'm 65, but honestly, every article out there says everyone in my demographic is retiring later because they want to.
Yeah.
No, they're not. Come on.
Well, here's what retirement plan sponsors say. Retirement plan sponsors and consultants who have pulled money from freedom funds told Reuters that they lost faith in the freedom funds because of their history of underperformance, frequent strategy changes, and rising risks.
Oh, I'm glad they had a great decade, but they had a horrible decade prior to that. So now you're a break even. I mean, appreciate that. Appreciate the work you guys are putting in there. But these things are just, to me, as I read, like I said, no one comes into the office and says, I really want this time date fund because it's outperforming everything under the sun. People want to avoid losing dollars.
But it's not so much I want to make a lot of money. It's just like I don't want to lose what
I've got. And you know what? Honestly, they don't care how you do it or how it's accomplished. That's not what they're doing. But the the deleveraging or the de-risk management here, the kind of, as I get closer to retirement, I want to take less risk. In today's environment, is a financial time bomb.
Yeah, you can have some major consequences that happen as a result of that.
In 5 or 10 years, if rates hit all-time highs, this probably won't be a bad method to look at. But,
whole different situation then.
But when rates are rising, so you have to understand your financial environment before you buy into something like this.
Well said. So that's going to do it for us today. Target, not to target. That's the question. I know that we've talked a lot with people bringing their 401ks to us and saying, here's what we have. They've got the target date funds, right? Or they have these other options and they've just kind of handpicked the smattering of them, and they've just, maybe you've done this yourself. You said, I'm going to put 25% over here, 25% over there. Well, guess what? That's one of the things that we love to help our clients out with, is taking a look at what they've got. What are the options? And that's what we do, is we help build personal portfolios for them with whatever it is that you've been given.
Seth, I'm going to interrupt you. I'm going to interrupt you right now because you did a great job just recently for a client.
Whoa. Stop. Let's re-record that. What'd you say?
I'm not going to say it again. No, I said it once. No, but you just actually did a great job with a client who had a sizable 401k, and he was really looking for some help from the risk department, because I think many times it's easy for people to go, maybe when they're in their younger years, when they're looking for that 2060 target date fund or whatever it is way out in the future, to go very, very aggressive. But one thing, and Ben, you've talked about this in the past a lot, where people, there's been studies that show that there is no rebalancing. There's no looking at the funds again after you do it initially. So people leave their funds in there for many, many years. And even when people retire or when people switch companies, they just leave it in that same fund. So people have the same funds that they bought 25 years ago, and they never rebalanced. And so this guy came in saying, these are funds I picked a long time ago. I really haven't paid much attention to it. And so, Seth, you did a great job of running a program that really helps people identify the level of risk that they have in their portfolio. And then you were able to show them an alternative that would help them actually to reduce the risk they're taking, but actually increase the return. Pretty fascinating stuff.
Based on that historical average. And that was an awesome report. I saw it too. And then on top of it, it's like, hey, listen, if you like the risk that you wanted, okay, here's the best way to optimize it. If you want the return here, here's how to optimize that return inside that. And it gave you basically one route or the other in between. That was a phenomenal report.
Yeah, and I will say this, Seth, in the analysis of that plan, the client did have access to target date funds, but basically based upon the risk exposure and all that, you just said it's time to be out of those, not to stay in those.
I know we have to get going here, and our last point, I think, is on these target date funds. There's a lot of conversation about fees. And, I think when I look at these target date funds, and we're all fee conscious, and some of the things that we do, can be more or less expensive and so forth. But honestly, for when you're paying somebody some of these fees that they're talking about in this article, Fidelity, I'm saying to myself,
what are you paying for?
What are you paying for?
Yeah.
Because if you want to deleverage or de-risk your portfolio, you could probably do it on the same time period they're doing it for a lot less money. Just come up with a schedule. Just learn the schedule.
And you need to stay active on it and be looking at it and making those adjustments.
But they're charging as if they're like they're charging equal weighted as if they're actively managing this portfolio. And I would not equate that to the similar standards of an actively managed portfolio.
This is a very profitable part of Fidelity's arm, actually, those time-dated funds.
It is. Absolutely.
You know what? This has been a great topic. You're right, John. I really enjoy helping our clients navigate those 401k placements that they have and maximize their returns and take a look at those and see, hey, what is this change going to do for me long term? That was the other side of it too, is like when we can take a look at our planning and how those adjusted potential returns might be. Oh my gosh, it can make a huge difference for people.
Huge.
And it's such a simple change for them to be able to take a look at what they have, make the adjustments now, and then hopefully reap the rewards. I mean, that's really what it is. But I don't expect people to know what it is that they have and how what the outcome should be. That's not what people are doing at their jobs all day long. So that's what we love to help you out with here. You can reach us at 855-226-8551. And you know what I would encourage you to do is what a lot of other listeners have done, and that's to call us. Let us help you out with your investments. And you know what? Maybe the set it and forget it is good for now, but isn't it nice to know that? At least to know that that's the right thing for you to be doing at this moment, or not. And that's what we're here to help you out with at Brayshaw Financial Group. Looking forward to next week, you guys. Thanks a lot.
Thanks, Seth.
All right.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.